Hello, everybody, and welcome to My Print Hash for week 14 of 2026. As always, I'm your host, Cameron Otsuka, along with Matt Dines here today. Today, we're going to talk about American growth and dynamism. I think we're seeing a flippening happening in the crude oil markets that Matt's going to explain through his lens, and he's done a really good job before this episode, kind of bringing me up to speed. But I want to make sure I try to distill that down for the audience here. So, just to kick us off here, if you haven't been following the news, there's been this new Artemis II launch that NASA completed. The first time we've launched astronauts towards the moon in I believe 50 years. So this is a big deal, both for the aerospace community, but for NASA and the U.S. at large. I think broadly speaking, anytime we're sending people strapped to a massive rocket, blasting them off at the moon, it's a pretty amazing accomplishment. Doesn't really matter, which country's doing it. It's still really cool to see. But as always, it's great to see that America is the one leading the charge there. But Matt, you saw something interesting with the WTI and the Brent crude oil markets, and I promised the audience that this is going to connect back to what we're seeing with Artemis. But can you explain first for us, what is it that you're seeing in those Brent and WTI crude markets, and how is that emblematic of what we're seeing broadly for American growth?
So this morning, I popped up my Bloomberg terminal, logged in to work, and something I haven't seen in a while was on the main front page dashboard. This is both on the desktop and then the mobile app. The WTI price was quoting above the Brent crude reference price. And I've got the graph here on the right because there's a lot of futures, different deliveries, et cetera. So it's kind of tough or difficult to do a pure apples to apples of what price is at any given point in time. But for the whole series, the whole chain, including the spot market deliveries, this is a big deal in my opinion. So prior to 2011, it used to be more common that WTI price would actually clear above the Brent crude contract, just reflecting the quality differences in the WTI market, as well as, well, it was also a kind of a landlocked market with delivery in the interior of the United States, all of that. But over the course of the aftermath of the 2008 crisis, I think from my read, we saw a lot of kind of structural implementations put in place so that the direction of premium actually revert or like flowed the opposite direction instead of east to west from Atlantic to or across the Atlantic from the North Sea fields and those local consumption economies towards the Gulf of the Americas and the WTI crude pricing venue. It's actually flipped the other direction. And I think this is reflecting the same commodity market kind of repricing, the taking of control away from the Europeans and the UK island nations, if you will, as the determining venues for pricing in gold and silver, as we saw, rear its head in November, December, and January at the turn of 2025 into 2026. I think these events in the Persian Gulf that have been at the top of the headlines since the Iran military operation on February 28th, as well as in conjunction with the January 2nd extraction of Maduro, which we view as bringing Venezuela and its energy markets, its local economy, into the orbit of this American sphere, right? Really centered around the Gulf of America and the Gulf Coast economies. Those two actions have basically, in all practical purposes, been a follow through taking control of commodity base level commodity pricing uh, into the hands of, it could be the United States or it could be China at this point for who sets marginal price. But what we are very clear on at this point is that it's no longer happening in Europe. So you see the chart on the right. These are pulled from the Yahoo Finance, time series. I don't think they're plugged deeply into the futures markets, but you see that $3 premium for what it was quoting the CL contract, crude oil WTI Midland versus the Brent crude basket at 108. This is a big deal. That is kind of secular in nature. This is a changing of the guards, if you will. Basically, a reversion of post 2008 kind of policies and structure that was put into place to put, in my opinion, the U.S. economy and its domestic capital markets on the back foot in support of foreign interests. So then, beside that, today we get this headline on the terminal for the Brent change tracker, and what this is we talk about the settlement of the futures market contracts. You've got to actually get the physical product to market, right, to deliver into the ultimate consumer. And the firms that do this it could be the oil majors who are involved as, the producers in this specific, oil commodities market. But then you also bake in the trading houses that we've talked about before, who align themselves with certain kind of geopolitical power factions. We've gone over this, especially in light of the Russian divestiture of its international oil production assets. That's still in limbo, right? Still waiting to be worked out. But what we saw in April for the chain cargoes loading was seven total crude cargoes, which is it's pretty low. What you're seeing from the traders here actually is this is one of a few conditions you would look for to set up a bullish squeeze. You would also want to see those cargoes kind of concentrated into one owner, which does, or one deliverer, or a small consortium of deliverers, which isn't really the case here, right? We've got those seven cargoes spread across Gunvor, which is historically Russian aligned, Chevron, a U.S. major, Mitsui, and then Trafigura and BP, one each. So you've got a spread across the geopolitical factions besides Gunvor with three. But I think the key thing, 5 WTI Midland cargoes. This is not unusual since 2023. We've seen a lot of production out of Brent crude shut down, and basically since the Russia-Ukraine conflict really geared up, you've seen most of the supply for delivery into the Brent crude settlement and delivery monthly loadings sourcing from the domestic U.S. market in the first place. So I think the net, as we're talking about Iran, we have a view of how we've kind of put the pieces together, what it means for knocking out of the IRGC, which is aligned with certain European capital factions, and putting in place a civilian government, or that already exists, right? But aligning the energy cash flows towards the civilian government in Iran, which will be friendly towards the build out of a key piece of real estate on the new Silk Roads, right? Or what we call today the Belt and Road Initiative, right? So that's what's going on. But I think this key signal you're seeing show up this morning with the Brent WTI premium flippening. That is a huge result, and it followed Trump's address to the nation, which didn't quite spell out the geopolitical framing and the capital markets wars framing that we try to kind of say the quiet parts out loud that maybe the media or our political leaders can't say. But from the speech, the delivery last night, he hit all of those notes while not making it you know slap you right across the face. That obvious.
Yeah,
In my read. So the market reaction this morning to flip those premiums. This was the first day since March 28th that the whatever index that front or whatever price, because futures prices you've got different monthly deliveries, and what they quote for the WTI number and the Brent number, they might not match up apples to apples, but this was the first time that front page it flipped since the beginning of this Iran engagement on February 28th to WTI being priced above Brent. So huge step here. And I think what it's reflecting, right? You think about the change of direction from, hey, we're going to use or we're going to structure the markets to bias towards giving a home field advantage or a playing field that's tilted in the direction of Europe. That's gone, right? The direction, the vectors flow towards the Gulf of America at this point, and that takes us right into this launch, Cameron, we saw yesterday. It was evening. Was it about 9 p.m. late evening Eastern time? It was like right. Well, no, it was earlier than
earlier
that,
than
but
that.
like 4
I think
o'clock
like
in the
four
afternoon,
o'clock Pacific
roughly.
time or something. Yeah,
Yep. Yep. But that launch, as I was watching it live and then thinking about it beforehand, the night before, as the schedule kind of held, it didn't get delayed, it didn't get put off any longer. It became apparent like, oh, they're locked in, they're ready to go logistically. It's this is going to happen. I thought about the failures, right? We've seen from the space program in the 1980s and the 2000s, the Challenger, the Columbia, as we just went through kind of a no man's land. We're in a new era right now, I believe, not just in terms of the space program, but American capital markets and growth in general. And failure here was really not an option, right? If this one had failed, it would have been very bad. There was I'm not kidding when I say like everything was riding on that thing being a success yesterday evening,
well, maybe explain that a
and
little
they
more when you say
delivered.
like everything. Like,
Yeah.
what do you mean when you say everything is riding on that?
Okay. So America, the economy, our monetary system, we need growth to deliver into, right? And that's really in the Malthusian sense. There is kind of a disbelief, perpetual disbelief that human ingenuity or new products, new technologies will just keep extending the frontier, right? And for all intents and purposes of our own lifetimes, of our, you can think multiple generations out. This frontier, we're not even close, right? Is kind of I would just call it the American DNA. I think that's how the American psyche thinks. Then you flip on the other side of that debate, you get into the Malthusians, right? We're gonna, outgrow our resources, et cetera, et cetera, et cetera. We're gonna immediately consume all of that available space, slack resources, et cetera. That'll ultimately result in lower standards of living. So we need to convince people to eat the bugs, live in a box, and and just agree to that whole premise. You'll own nothing and you'll like it, right? America like has to shatter that mindset and not just not just live around it. Like it has to soundly defeat it for this kind of experiment that is self-government, self-rule, self-control or sovereignty of your own capital markets. You have to prove that you can push that technological frontier, which ultimately gives your economy and your people that potential to grow into, right?
Right.
And so for the next like 5, 10, 20 years, We can have this retreat into American isolationism, but if we don't have those projects or that kind of emergent frontier, um, it's just there's no growing pie to spread around. There's nothing to increase credit creation into, um, and ultimately there's no productive debt to fund projects into. So if we can't prove that there's multiple fronts of growth, but space exploration and these Artemis missions are definitely one of them, in my opinion. And so, thinking about this symbolically, right? You've got Artemis, which is the twin sister of Apollo. Think about the Apollo missions of the 1960s, and I think the final one would have been the 1972, right, Cameron, if I remember correctly.
Yeah, I believe so.
Um, it's kind of a return in my mind, the symbolism here of those kind of two bookends. When we broke the old Bretton Woods standard or the constraint, Nixon took us, or he closed the gold window, right? You go into the first you go through the inflation of the 1970s. You mark up all of the commodities, everything. You debase the dollar, and then you just do this massive credit expansion on the LIBOR standard from 1980 to 2020. And I think like what that represents to me is, we really just, we increase, we did a credit expansion in the global banking system or the global financial system into the framework that was already in existence, right? We talked about the global trade paradigm, we got the iPhone, we got flat screens, and we just milked that one, squeezed every drop out of it. But we're at a point now after COVID where we've got to find that next thing, the next growth to lend into. And it has to be real. It has to actually be like on that frontier where it is, uh, productive debt that's being created into this economy, all that stuff to ultimately increase standards of living. My point there, most of the debt on the LIBOR standards, we know this. It was a mix. Some of it might have been productive, but on the net, what happens when you increase credit and it's not going towards productive debt, you're increasing money supply. That shows up in financial assets, right? It's not going into any, you know, uh, lifestyle improvements, et cetera. You're just purely marking up financial and real assets, including not just including equity indices, all of that, but it's also your housing stock or stuff like that in real terms that people need to live in. So this whole mindset or this whole kind of framework of between the Apollo and Artemis missions, those twins, everything else, that was a lull. That was in my mind a retracement. American growth was not able to kind of realize itself, and these Artemis missions are the proving point. Um, if we don't have those viable, we don't have a next 5, 10, 20 years, if you think about it too. And there's another element around this too, I think with AI, right? The, upfront AI, is expected to cause job losses, replacement, all of that. You've got a deflationary impact there. You're going to have slack resources in the economy. Those resources need to go towards productive projects. And I think Artemis is just, one arrow in the quiver that America has. Um, and I think it's an exciting one here. I don't think we want to spend too much time going through the full series, but we're on step 2 of what could be a multiple a multiple mission sequence
Yeah.
here, and we'll just take this as far as it can go. The end game here is it's a pretty big vision in my opinion. Still don't know if it can be fully realized, but that's the point of exploration. This is like sending out Columbus, Magellan, etc., that the Europeans did at the turn of the 15th and 16th centuries. I think America is showing it's the torchbearer on what the West is when it's at its best.
And I think then that leads directly then into the geopolitical piece of this, right? Which
Yep.
is these Artemis Accords. And so just to give a little background here, NASA and along with the U.S. State Department was able to get signatories from, they say here, more than 60 different countries. Um, so obviously, when we start thinking about these scientific kind of projects, you often hear a lot of signatories from different countries, things like that. But Matt, you see this map. Uh, I think you made a few comparisons to other projects the U.S. might be going through as well. So maybe you can explain what you're seeing and any core callouts you want to make with the blue on the map here.
Yep. Well, I'd say notice first the heaviness of the New World, the Americas. I think we've gotten buy-in from, I mean, most of the map, and I expect to continue some of those gray region, turning some of those gray regions blue. You think about Venezuela, we brought that into the Monroe Doctrine orbit. That should come in blue here. But basically, what I think about these doing, or what I think about happening here, is these economies are buying into this coalition, this project. Um, it's going to be led by the United States, but they're going to contribute resources and align their economies towards this big picture vision, right? So that's the Western hemisphere. You've also got the legacy, world post World War II, Western coalition members, all the Eurozone, all the UK. You don't have Ireland flipped on yet. All of Scandinavia. You got Australia, New Zealand, Japan, etc. And then a little bit of GCC representation. India's in as well. What you don't see here is actually kind of the Asian powers, China, Russia, and everybody in between on those land-based Silk Roads. So this is kind of a complementary set, if you will, to what we're talking about, that old order of those maritime trade routes that link up, across the Pacific, transatlantic, Persian Gulf, Indian Ocean, utilizing all these key choke points we've heard so much about in the news over the years. Um, this one here with Artemis, you really separate what's going on with the Asian powers and the land-based Silk Roads. We call it the Belt and Road Initiative countries, and I think from a resource perspective, this is signaling where the puck is going for the other side of that, right? So the U.S. obviously, or the Americas, they'll be somewhat involved with the Belt and Road initiatives, but the bread and butter of that, the backbone is going to be, Marco Polo's trails we saw. Go look at the map. It's going to look very similar to that, and that's where Iran comes in as a key piece. You need that land to be a stable, just kind of stop. You need a stable government along the way with some authority and cooperation with the partners, along the other stops on the road. So I think this map we're seeing on Artemis is actually kind of a leading indicator of where you're going, for just where you expect resources to allocate in the future for a cooperative bloc,
Right.
as this project gets bigger and bigger with every success on that Artemis kind of project roadmap.
And let's flip then to the other leg of this kind of, or the other thread that you talked about, which was capital markets. So, Goldman Sachs tells clients it's eager to short tells clients that are eager to short loans that its tool isn't ready. So, when I saw this, my initial thought was just Goldman couldn't line up enough bag holders for the private credit funds that they're trying to short. But, Matt, what's your read on this, and how does this relate to kind of some of that American growth that we've been talking about? Why is this not ready yet, and why do you think this is a key kind of headline that came out?
Yep. So what it's talking about here is a total return swap product that Goldman would sell into its clients, right? And our firm Build, we are a client. We have a counterparty relationships with Goldman Sachs. So it'd be asset managers, hedge funds, could be pensions, et cetera, who would um, either buy or sell or go long or short the return on this basket of leveraged loans. And we'll talk about what those are in a second. Um, and on the other side of their trade, they'll have to pay. That would be the uncertain return, like what happens in terms of total return for this loan portfolio. Um, and then on the other side of that, you would either go long or short a fixed interest rate on the opposite end of the swap, right? So, what are these leverage loans? Just to start, they are over-the-counter private loans. What does that mean? It's kind of like bespoke one-on-one um, bank or regulated financial intermediary originated or underwritten um, debt that doesn't trade on your typical broker dealer liquidity exchanges. So what do I mean by that? Or venues. Let's just not say exchange. It could be just a venue, right?
Right.
Um, so let's say we're looking at the investment grade debt market or high yield debt market. Those are supported by a network of broker dealers who provide liquidity. They internally report up through like the trace and architecture for price, clearing, settlement. So um, there's observability, across the market on what's going on with liquidity, price discovery, all of that. Versus the opposite end of that would be an over-the-counter market where price and trading is opaque. We don't quite know, who is trading. It's not necessarily reported. So by definition, this leveraged loan market is more difficult to structure. This total return swap product that Goldman Sachs has been kind of marketing to its clients who wanted to short. We talked about the story, in the prior weeks, February. This is the big story, and credit markets. The kind of the creative destruction of software loans in the private credit space and the leverage loan market space. That AI was really, uh, the narrative was AI was eating its lunch,
Right.
right? Um, so part of the reason why this total return swap on leverage loans is difficult to structure. No borrowing market exists, right? You can't go and buy and short these shares like with your broker dealer counterparty, like you could for like an exchange traded stock or even say a, a more like a trace eligible QSIPT debt offering, like you could. There's also like talked about the pricing opacity, but there's a settlement lag. It's actually something on. It's not T+2 settlement like you can do for sorry, T+1 now. We shortened a day in the last 2 years on trace eligible bonds, right? These loans, just because of the counterparty uniqueness. They're over the counter, they trade off exchange, all of that. You've got longer settlement times, so they're T+10 all the way to T+20 plus. Like they just the whole process takes longer, and then that makes the daily mark to market for these total return swap termination and margin calculations. I would say like more contentious. You can argue over them more because you don't quite have these market reference rates or like a true oracle to look at
Right.
and set price on these swaps. So it makes it more difficult to fix and nail down, which if you're thinking about it from the standpoint of a counterparty or a hedge fund looking to go long against this instrument with Goldman as your counterparty, uh, there's a lot more fudging that can go on, which makes this, a more, I guess you'd say, just a more a product that is geared towards more of an affluent or what would you call it, just an educated,
Larger
a
institutional.
high
Yeah.
end institutional audience or product for this market. There's also no standardization for like the reference rate, so the indices themselves for leverage loans, they don't fully have that built out yet, and there's some wrinkles there too, where we talked about all these loans. The liquidity profile for each of them may be different. The ones that actually trade are by definition going to be the most liquid. So it makes it hard when you don't have quotations, and dealers axed on, say, a lot of these loans that might be at the bottom of the barrel, but they make up a decently large kind of cross section of this market. And yeah, Bloomberg noted that, like, just arising from that, you get into the liquidity paradox. It's the most liquid loans that get hit the hardest, not the riskiest. And when you're thinking about pricing, right, you got to price at fair value. If someone is selling into a forced liquidity fire sale, right, it makes it hard to determine where do you mark these things on a day-to-day basis. Because if the index itself marks, or it like fixes based on the fire sale price, based on the most squeezed longs on say a levered loan, if you price the whole thing at that, it's just going to force
Right. It just
everybody, drag them down into the hole
right.
with them. So there's a lot of kind of intricacies here in this illiquid uh, OTC market to build around, and Goldman just isn't ready for it yet. So I didn't really talk about this up front, but how does this work, right? How does this whole complex work? Just the assembly line is pretty straightforward. Financial institutions create these loans. They'll underwrite them, create the credit, et cetera. And then what they're looking to do is actually sell that loan to a new, like, ultimate balance sheet, who will be the long-term owner, and that's where the CLOs come in, right? So the collateralized loan obligation, CLO funds, they're the ultimate buyers here, and then they'll sell, to map those assets ultimately to the final beneficial owner, which is, it's looking to be pensions, insurance companies, et cetera, other long-term holders of the debt. Um, and what you see when the market, Cameron, if you go to slide 9 here, when the market starts to, if there's a problem in that kind of assembly line of the production process, as the sausage gets made for these small and middle market, you know, uh, credit creation that takes place, what you would generally see is the buildup on the balance sheet of the originators and underwriters, who, they'll fund the loan to create it, but then really what they're trying to do is just be a middleman and pass it off to the buy side, if you will, which is the asset managers, hedge funds, et cetera, who go long those leveraged loans via the CLO containers, right? My point here: how would we know if this whole little market is becoming a problem? One of the things you would look for to signal that there's a bottleneck on the assembly line, the insurance companies, the pensions, et cetera, those final buyers um, who sit on the asset, they would show some sort of capacity constraint. They would stop buying. Um, and that's where you would expect to see the inventory of trading assets, or assets held for trading, to start building up within the what do you call it? The non-shadow banking, like the regulated banking players, who are the ones doing the credit creation at this point. And this series here is from the H.8 report. We talk about this a lot. It's the weekly survey that the Fed does on the commercial banking system's balance sheet within the regulated, domestic U.S. Financial system, or commercial banks. And the first call out here: go back to the window 2001 to 2007, where the growth kind of engine that the credit creation was going into was household real estate, and specifically we mean subprime. This fool's gold invention: hey, if we pool this, a bunch of subprime borrowers, and we securitize it, chop up the risk. We can create a bunch of AAA assets, and growth growth will
Magically happen.
magically drop
Yeah.
out of this. Yeah, we found out that was all BS. Didn't work. And one of the key things, like when you knew the problem was arising, well, after like the early players, the Michael Burrys, all of that, they would have went long the equivalent of like what Goldman Sachs is talking about here, this total return swap on leverage loans. They went long the CDS market for the, let's say, the AAA or the senior tranches, or mezzanine tranches, the upper capital stack of the subprime real estate kind of sausage factory. And ultimately, when we knew it was going off the rails, was mid 2007. Once we knew the music stopped, as Chuck Prince, CEO of Citigroup at the time, would have said, the signal would have been the buildup of, just call it these assets or just the loans, the sausage just getting bottled up at the production plant, because there's ultimately no one willing to buy anymore. Keep saying the sausage anymore. So that's when you know the music is up. And my point here, you look at the trading assets so far, it's still following that linear growth path. And I would say for everybody who keeps talking about this private credit issue or leverage loans issue, it's not going to be exactly the same as 2008, in my opinion. Root cause of why these loans are commercial. It's commercial lending to small and mid market that the U.S. banking system doesn't want to lend into um, by itself, right? So if you think about the banking system, what they do is they are the ultimate creators of expansion in the money supply, right? And when they create a loan, literally print money that the private sector uses, they hold about call it 8 to 10 cents of equity behind each loan. If these credits go bad, you're lending into risk in the commercial markets, right? You're lending to entrepreneurs who are satisfying new demands, building new products, uh, uh, spinning up a supplier to build widgets for the Artemis mission series, right? It's risky. Um, but what you're doing here with private credit, or leverage lending, et cetera, you're doing it as the commercial banking system at a, let's say, 2 to 1 leverage. So you've got the upper or the senior 50 cents on every dollar worth of credit exposure, but there's someone else's 50 cents of equity behind it, to backstop your commercial banking system from potential losses and balance sheet contraction. That will ultimately, like, that's the ultimate Achilles heel of any fractional reserve banking um,
Right.
framework, right? So I think what you're seeing here with the Goldman issue that sprung up, because they were saying as recently as March 9th, hey, we're going to get you a product to allow you to short these. Everybody wanted to short the things like the software private loans that sprung up. You're seeing it in the gating of funds like Blue Owl, et cetera. We could pull those headlines up too, but I think I saw something, they got redemption requests for up to, I want to say like
Yeah.
40%, and another fund got like
20%.
20% of capital requested. What this is in my mind, this is a rush for liquidity. It has not so far tipped over into a credit risk or impairment, is what this signals to me. Could become that if Artemis had blew up, these products, these growth projects that the U.S. is engaged in, including AI, data centers, et cetera. If these are non-productive, or they turn out to be non-productive, it will go, but or it will go that route, potentially turn sideways. But at this point, we don't know for sure. Um, it's a tug of war between um, the bulls and the bears, as they say. Um, but I guess I would say this: we're not Malthusians. We're pro growth, and I'd say it's always dangerous to bet against humanity to figure these things out. All right. And so the last thing on this front, we're talking about like why is this a liquidity squeeze and not a credit event so far? We got another signal of that this morning or Thursday with the 10-year JGB auction, which recorded the largest tail we've seen at 36 cent. I'll go into what that means and translate it. Um, Largest tail since April, or August of 2024, which was, if you remember this, this point where the yen carry trade just hit the headlines. This was where everybody, stayed at a Holiday Inn Express and became an expert on the yen carry trade, as all the social media accounts will pop up to tell you whenever something happens. Right, there's no shortage of experts. But what this means, just quick, the JGB market, they report their tail in terms of bond price. And sen, I didn't know this, but sen is like is to the yen as the penny is to the dollar. So
Oh,
it's one per hundred, or a hundred sen is 1 yen, right? So they record this in terms of price slippage on the auction, whereas U.S. auctions, we would report this as a tail in terms of basis points. Um, and a 36 sen tail roughly equates to a 4 basis points thereabouts tail on the 10-year auction, which is big, right? It tells you there's liquidity pressures, like balance sheet constraints within the financial complex. So generally, what we saw in this in April was risk assets and FX liquidity pressures. We just saw this. It's April 2nd. Um, if past is prologue, what this means is more pressure on the sell side, I would say, or towards better selling on risk assets. And just to go in, if everybody remembers, August of 2024. Um, I circled it in red here on the chart. This is the triple Q's weekly 3-year chart. Um, Everybody was losing their minds as, hey, the yen carry trade is exploding. In hindsight, it looks, okay, that's just a stock chart, guys. Don't lose your minds over it. And it was nothing close to the divot that liberation was, um, that followed in about 9 months from there. But I would say be prepared for market volatility. If this JGB yen tail looks anything like it did in August of 2024, and I think if you're looking for a just a headline or something to attach to, like what's it called, like the goldfish memory, right? To finding Nemo, where the other fish's name, who just couldn't remember anything. It's
yeah.
always the shiny object right in front of your eyes. Don't be surprised if whatever happens with whatever this 10-year JGB auction week result is telling you is coming in the next month, or 4 to 6 weeks, that type of time frame. Don't be surprised if that shiny object uh, gives the distraction. Hey, look over here, and everybody, it gives you, or it gives this administration just that window to take attention off of the Persian Gulf, Iran, etc. Win that battle, move on to the next thing. Don't be surprised. Just in my kind of framework of what you should expect around the corner, this volatility, this episode, we'll re-sticker the narrative and move on to the next thing.
Yeah, and I think that's a good spot to maybe kind of summarize back, Matt. We started off talking about specifically the Brent WTI kind of oil flippening, right? Price flippening, and how that relates to American growth and dynamism. And I'm curious, Matt, maybe for the audience here, just summarize those threads here, going from that concept through Artemis and then finally to these capital markets, how that all ties back. I think you had a good way to synthesize those for us.
I would say it foots back, that flippening of the Brent WTI premium. That's your signal. We're in the stage where we're back to American-led growth. It's basically get on the bus or stop complaining. But we're moving ahead, and so far, I think what we're seeing from the market response is um, kind of the free world, the Western coalition coming out of World War II. Um, they're falling into line, or getting in line behind kind of the marching orders with the U.S. as the lead. And I think that rounds out with this proof point with the successful launch of the Artemis II, which I think, yeah, it's a big event. It definitely didn't get underreported, but in terms of just how it plays into this narrative, I think it just is uh, one of the key examples of the revival, right? So far, it's just been from the standpoint of the U.S. aerospace sector. It's just been beating up on Boeing, like who else? Like just it's
Yeah,
just
these
it's been a
big
bad
starts
look.
trying to
Yeah,
yeah.
for the legacy kind of sclerotic. Um, it's just logistics uh, suppliers and that network. But I think what we're showing here is America's ready to lead for the next 5, 10, 20 years. We've got a vision. And I think what we're slowly seeing is those old partners leave the European-led orbit and fall in line with America as the torchbearer. So keep watching, but it's going to be a bumpy process. This is not going to be smooth. Obviously, there's going to be other players who want to see us fail, so they can sit on their uh, I guess like status at the top of the perch. They don't want to lose what control over um, the legacy governance and financial system looks like. Um, but I think ultimately this is not stoppable.
Yep. Great. Well, thanks again, everybody, for watching. This is another week of the MyPrint Hash podcast. As always, follow us on Substack, myprinthash.substack.com. Matt and myself are also on X, along with the MyPrint Hash X account, LinkedIn, YouTube. Please subscribe. Let your friends know. I'd love to see the comments. Thank you again, and see you all next week.